Good afternoon, everyone. My name is Juanetta Ayers. I'm the Executive Director for Commonwealth North. Thanks for joining us for today's program. It's a pleasure to have you all join us. Unfortunately, our board president, Terry Smith, is not able to be with us today, so I'll be pinch hitting for him and doing the introductions. For a few ground rules, again, we always welcome your engagement. You can use the Zoom chat platform to submit your questions for our guest speaker at any time. I am going to suspend the texting option today just because I'm juggling a few other duties than what I normally do. So I do apologize for that, but necessity requires that. So again, submit your questions at any time in the Zoom platform and we'll take it from there. So today we have a presentation by IHS Markit about their recent analysis of Alaska's competitiveness in the oil and gas markets, both domestically and internationally. The briefing also addresses Alaska's future competition for oil and gas investment. IHS Markit is a world leader in critical information, analytics, and expertise, forging solutions for major industries and markets that drive the world's economies. Today's speaker is Irena Agalliu, a vice president at IHS Markit. Irena is an expert in international energy law and economics, worldwide fiscal arrangements, commercial risk, and other above ground risk investment related issues. She has over 15 years experience in the upstream oil and gas industry. Irena advises governments and oil companies on regulatory and contractual developments that impact exploration and production activities worldwide. She assists governments in formulating policies and decisions to foster an attractive investment climate. Before I hand the program over to Irena, I'd like to thank our Commonwealth North members who are with us online today. Now more than ever, your membership and your engagement helps to sustain Commonwealth North. Thank you for your support and the work that you've done to educate leaders, policymakers, and our fellow Alaskans about our state's most critical public policy challenges. I also invite the rest of you to join us if you can and support our mission. I'll provide some information in the chat window in a few seconds. But now let me turn the floor over to Irena. The floor is yours.
Thank you, appreciate it. Let me share the screen. Can everyone see my screen?
You're looking good, thank you.
This analysis was prepared to among a range of projects that API considers looking at competitiveness of oil and gas fiscal systems around the globe, and IHS had recently completed a study for the US government Department of the Interior related to competitiveness of the federal oil and gas fiscal systems. Given that Alaska's had a proposed measure, Ballot 1 initiative already in sort of in the works, our competitive analysis looks at the current fiscal system compared to other jurisdictions, as well as the likely impact of Ballot Measure 1. This was a team effort by various members of our team of Montero, Stephen Adams, and Divya Ramaswamy. Unfortunately, she's trying to join the call. She's having technical difficulties. I hope the organizers will be able to let her in. In the meantime, I will proceed with this presentation. First, I will describe the methodology that we used for this analysis. In order to provide an apples to apples comparison for Alaska's fiscal terms, it is important to select the right peer group. Alaska currently competes for investment in the domestic and international market. So it is important to consider its competitiveness in the international as well as US lower 48. For the international comparison, we selected deepwater offshore oil fields, mainly because they are considered comparable with Alaskan North Slope oil fields in terms of both reserve size as well as cost of development and production. With regard to the domestic market, we focused on the lower 48 tight oil plays. Perhaps some of you may not be familiar with the word play versus oil field used in Alaska. Play is a natural clustering of both commercial and undiscovered petroleum accumulations. With regards to unconventional resources, it relates to low permeability source rocks with minimal oil water or gas water contact. So there is a difference when it comes to conventional fields, and internationally we're looking at conventional oil field development comparison, whereas in the domestic market we're focusing on tight oil plays. And the main reason for that is because this is where the main E&P activity is occurring in the United States right now. So those are the areas where most of the investments, at least was going prior to the COVID-19 crisis. With regards to field size and development concepts for the conventional field development, we looked at a theoretical field of 500 million barrels modeled after Alaska's North Slope, and compare that against 500 million barrel oil fields in deepwater Angola, Brazil, Guyana, Norway, UK, and the US Gulf of Mexico. We considered brownfield developments because this is where the majority of the production is coming right now in Alaska. The large Alaskan discoveries in Prudhoe Bay, Cooperuk, and others in the North Slope produce over 80% of the oil produced in the state currently. So that's where the analysis is focused with. However, we're not using one size fits all. The developments between these jurisdictions vary. The development concepts feature actual cost of developing this size fields, the 500 million barrel oil field, in the respective jurisdictions. They account for differences in water depth, total vertical depth, regional costs, distance from liquid markets, well outputs, etc. We have relied on current 2020 cost for this project. When it comes to comparison with the lower 48, we're focused on tight oil and shale plays in Colorado, New Mexico, North Dakota, Texas, and Wyoming. Unlike the conventional field analysis, here with regards to tight oil plays, we're looking at single well economic models for this analysis. And the reason for that is because of the aerial extent and the availability of drillable locations in each play. Not all the plays met the criteria to develop project sizes that would result in 500 million barrel oil fields. So in order to provide apples to apples comparison, when we consider the metrics for this type of analysis, we focus on the net present value per barrel with regards to tight oil plays. That will normalize results across the sort of field development concept in the case of Alaska and well development concept in the case of tight oil plays. For those of you that may not be familiar with the net present value concept, it is the difference between the present value of cash inflows and the present value of cash outflows. Basically, in order for a project to go ahead, you need a present value greater than one. Projects with negative present value mean that they are not profitable and investment is not likely to go forward. In the case of international jurisdictions where we have similar sizes, we're looking at both NPV per se, as well as the NPV per barrel. NPV is the short form for net present value. Whereas with regards to the lower 48, it's not possible to do the NPV comparison given the different sizes of resources in the single well economics and field level economics. So we're focusing on NPV per barrel. In addition to that, we're also looking at the government take metric, which is a metric often used by governments. However, it has its own flaws. It may tell you comparatively where you are with regards to other jurisdictions, but it does not necessarily tell you whether the project is profitable or not. And we can see that in some of the cases when we consider the low oil price environment. We are using a 10% discount rate for this analysis, which is also the rate used by SEC for reserve evaluation. So this is a common discount factor applied. With regard to prices, given the volatility that we currently see in the market, we have looked at a range of prices, 25 and 35 representing the low price environment, 60 representing the base case, and 85 per barrel representing the high case. The $60 per barrel price was considered to be the base case scenario pre-COVID-19, and the assumption is that $60 per barrel will ultimately be the base case scenario in a post-COVID-19 world, maybe 2 or 3 years down the road. This is just a graphical presentation of some of the large fields that exist in North Slope. The ones in brown color are basically existing discoveries, or what we consider brownfields. These are fields that have a cumulative production of oil greater than 400 million barrels and also have a daily production greater than 40,000 barrels. Usually developments in these fields occur in stages. So there is significant potential, undeveloped potential in these fields, and these are likely to be, to continue to be the main supplier of crude oil in Alaska. This production from these fields currently makes up 84% of the production in the state. We've shown here fields such as Willow and Pika. They're likely to be impacted by Ballot Measure 1, but not necessarily as much as the brownfields. So our analysis for this project focuses on brownfields, primarily because they constitute the overwhelming majority of the production in the state, and secondarily because they are also a target of Ballot Measure 1 initiative. When we look at what does the Ballot Measure initiative constitute, with regard to greenfields, the impact is smaller because you'll have to have reached at least 400 million barrels of production for it to kick in, and you also have to have had 40,000 barrel per day production in the previous year. So if you see the figure at the bottom left-hand corner of the screen, you can see the area in green, whereas the likely sort of the production affected by this measure. Whereas when we look at brownfields, we are likely to see because those are in stages and earlier stages of whether it's Prudhoe Bay or Cooperuk or other brownfields existing in the North Slope, they've already occurred. So when you enter the second or the third stage of development of these projects, they've already met the 400,000 cumulative production, 400 million barrel cumulative production. So they will be subject to the tax from day one. What does Ballot Measure 1 consist of? It applies on top of the already existing production tax that is levied at 35%. It is the greater of either 15% of the difference between a $50 per barrel in the production tax value of oil, or an alternative minimum tax of 10 to 15% of gross production value. This tax rate starts at 10 for Alaska North Slope prices of $50 per barrel, and it increases by 1 percentage point for each $5 per barrel increment, up to a maximum of 15%. Moving on to the analysis, as we mentioned earlier, we have divided the groups into international and domestic, and then we will look at those changes combined together when we go to global competitiveness. But with regards to the net present value per barrel within the international peer group, we see negative values across the board, whether it is at $25 or $35 per barrel, which indicates that most deep water projects, as well as Alaska North Slope projects, are not economic at this prices. No one would sanction perhaps projects at this price level in these jurisdictions. With the exception of Angola and Brazil here, we at $35 per barrel, the majority of the jurisdictions are sort of have negative NPV per barrel. However, one thing we notice as we move from the $25 per barrel price to the $35 per barrel price, Alaska's, whether it's the current also, as well as the proposed measure, they slide down within the peer group to go to the bottom of the peer group at $35 per barrel. Obviously, the ballot measure one exacerbates, so the negative value moves from 2.5 to minus 2.5 to minus 3 in this instance. As we move towards the base price scenario that we're considering at $60 per barrel or higher, towards $85 per barrel, the projects become economic. However, they are not competitive, both the current case and the proposed measure, especially if we look at the 60, because the $85 per barrel is probably least likely sort of to happen in the near term, but the $60 per barrel that we expect or we hope to see in a post-COVID-19 world, under ballot measure one, Alaska's sort of NPV per barrel is barely positive. And it is, even the current fiscal system is 4 to 5 times, yields 4 to 5 times lower value per barrel to investors than the, let's say, Brazil or US Gulf of Mexico cases. When we look at the government take data, we see a lot of cases where the 100% government take figure shows up. When projects are not economic, and especially when investors are not able to recover the capital and operating cost, the government take actually is above 100% because the investors are negative, but they're paying, let's say, royalties to the government no matter what the loss. So in those instances, the mathematical value is greater than 100%. However, in our analysis, we usually cap it at 100%. The idea is that the government takes all, whereas the investor is getting nothing. But if you see data from sort of other analysis and compare against ours, please keep in mind that ours is capped for all intents and purposes at 100%. However, if you look at, and this is why I say the government take measure is not usually a very good indicator, is if you look at cases such as Guyana 75 or Norway 77 here, it's below 100%. But if we compare, if we remember what it was when we looked at $35 per barrel, then NPV per barrel was negative. So these projects are uneconomic. So the government take in this instance is not a very good indicator of project profitability or whether investors would go forward with projects in these jurisdictions under a $35 per barrel price. That's why we offered a combined analysis of the government take as well as the net present value or NPV per barrel. As we move towards the base price scenario and the high price scenario, again, there is a slight move of Alaska's government take vis-a-vis other jurisdictions, especially the current system. Under the current system, it had a lower government take than Guyana, and then it moves into under $85 per barrel. It moves one step down within the international peer group. In terms of change, we see a change by 9 to 11 percentage points, which is significant in terms of government take for these projects. When we then look at the total NPV at the project level, we see under the low oil price environment a loss of about 200 million per project in the low oil price environment as we move from the current fiscal system to ballot measure 1. The same can be said under both $25 and $35 per barrel price scenarios. At this point, it is a bit theoretical in the sense that most investments would not go forward under these price scenarios. Companies are not likely to invest given negative NPVs. However, this changes when we move towards $60 and $85 per barrel. The loss is much more significant. We see at a project level a loss of about 450 to 700 million per project under both the $60 and $85 per barrel scenarios, and as well as a ranking at the bottom of the peer group, international peer group in terms of the net present value yielded by Alaska North Slope projects. They're positive, but they're significantly lower in terms of returns to investors. When we look at the lower 48 peer group, we have a lot more there is a mixture in some states. We're representing here more than one play. We've looked at the Permian Basin, the Bakken. We've looked at Parkman and Turner in Wyoming. We've looked at Niobrara in Wyoming and Colorado. So the results, because we're dealing with type curves, they're not at the state level, but they're at the play level in this analysis. When we get to the global one, we come up with some sort of averages at the state level. But as you can see, at the play level, in the $25 per barrel price, Alaska's fiscal terms, or sort of, even though negative, the net present value per barrel, it is somewhat towards the top comparatively. As we move to higher prices, the progressive nature of the levies in Alaska, also combined with the nature of tight oil plays where these wells have most of the production, when they turn positive, they have most of the production in the first 2 to 3 years. So in terms of net present value, they bring a lot more value to investors as we move towards higher prices than conventional fields that take sort of a few years to reach peak and plateau. Basically the production profiles are completely different, so you're not going to see a symmetry when we move from one price scenario to the next. And as we see here, so if you remember in the previous one, at 25, Alaska's current and proposed measure, even though negative, they were sort of towards top of the peer group. However, nobody would invest at those price levels. But when we get to the $60 per barrel compared with the tight oil plays, Alaska's current and proposed measures move towards the bottom of the peer group. And then at $85 per barrel, the progressivity of the Alaskan fiscal system contributes it to being the least competitive ones in the peer group. And the order of magnitude in terms of value per barrel is huge. If you look at Wyoming, Parkman, Turner, or even Wolf Cap middle hotspot in Texas compared to the Alaska current system is at least 6 times higher in terms of dollar per barrel present value. With regard to government take, all projects in the lower 48 are sort of have 100% or greater government take under the $25 per barrel scenario. They're not economic, similar to the case of international jurisdictions. Somewhat the same, even as we move towards $35 per barrel, with the exception of 1 or 2 plays. The majority of the plays are not economic at this price. So even government takes of 74 or 80 do not mean that the projects are economic. But in the case of Alaska, the current, sort of under the current measure being 82, if we remember where I'm going back to where it was, Alaska current is minus it's a negative $2.5 per barrel net present value, which shows you the project is at a loss. So therefore, they wouldn't go forward. So an an 82% government take is not a consolation price in this instance, because no project moves forward at $35 per barrel. When we look at $60 per barrel, from a government take perspective, even though Alaska doesn't fare well from a NPV per barrel perspective, it's kind of in the middle of the pack, the current system from a government take perspective. However, you have to keep in mind, investors usually don't look at government take, they look at how much their return per barrel is, whether it's in terms of rate of return, net present value, or other profitability indicators. But the current, the proposed measure moves Alaska at the bottom of peer group, even in terms of government take. Here again, we see a 10% increase, 10 percentage point increase in government take. At $85 per barrel, even the current system, given its progressive nature, moves to the bottom of the peer group. Most of the lower 48 fiscal systems are regressive in nature. As you can see, as they move towards higher commodity prices, the government take goes down for most of them. The opposite is in the case of Alaska. The government of Alaska tries to capture most of the upside. So we see an increase in government take. Another factor that influences investment in Alaska is the perception of stability of the fiscal system. If Alaska is considered to be to have one of the most unstable oil and gas fiscal systems in the world. I've been observing changes in fiscal terms for my entire career globally, and we do comparisons quite a bit, but Alaska is one of the jurisdictions that since at least 2006 has changed its oil and gas fiscal terms more frequently than any other jurisdiction in the world. And this is 8 instances within this 14-year period. Sometimes we see them back to back from one year to another, as in the case of 2006 and 2007 measures, or 2012, 2013, or 2016, 2017. This adds a lot of uncertainty to not just existing investments, but future investors. There's been a report of loss of investor confidence in the system, and measures that were introduced, especially in the 2016-2017 period, have been reported to have driven away the smaller investors from Alaska. When compared to other jurisdictions, we're looking at a period since 2014 when we had the oil price crashing from $100 per barrel to as low as 35, I believe, by 2015. So what we saw and what we usually see as a general trend as oil prices go down, governments take measures to incentivize the industry to keep the investment and to attract to continue to attract new investment in their own jurisdiction. So you can see at the bottom of these graphs are jurisdictions that have taken measures to lower the government take. UK is one of the, if we look at it, most active ones, having taken measures for 4 years in a row, and currently has the most attractive oil and gas fiscal system in the world. UK system was considered somewhat unstable, similar to Alaska, because during a period from 2002 to 2006, the United Kingdom had introduced a supplementary charge starting initially at 10% and 20% and then 32%. However, since 2009, after the 2008-2009 oil financial crisis, and the UK took several measures. Here we're only capturing the ones from 2015, but has taken various measures to incentivize the industry. Even the US government took measures in 2017, whether it's with the corporate income tax that introduced depreciation of 100% of assets for the first year bonus, lower royalty rates for shallow water. In 2016, the US government introduced a royalty valuation rule that did not favor oil and gas investors. Was a tighter rule in terms of how the US government determines the value for royalty purposes. That was never implemented, so it was repealed in 2017. But it's worth noting that among the jurisdictions that went sort of against the trend, which was Colorado and New Mexico, they increased the royalties to 20%, New Mexico only in the case of the Permian Basin, the sort of highly prospective basin. But Alaska stands out as having taken measures twice in this time period to remove or take away incentives from the industry. And if ballot measure 1 is going to be to go through and be approved in 2020, that would be sort of another measure that basically goes against the general trend of other jurisdictions that have significant oil and gas resources. Looking at the results of the study at a global level, one of the reasons that Alaska's fiscal system or the results are not as favorable as those of other international jurisdictions or the lower 48 states is the higher cost required to break even at 10% investor rate of return. This is a combination of the high cost associated with North Slope, but also a combination of the highly progressive fiscal system. This represents the current fiscal system. It's not based on the proposed measure. As we can see, the average break-even price required for a 10% IRR in Alaska is higher than the other jurisdictions. Therefore, it was important that we conducted this analysis, not just focused on government take, but also the net present value or NPV per barrel to investors. Looking at NPV per barrel to investors, as we saw earlier, under the base case scenario, both under the international and domestic market, Alaskan projects are not competitive under the current as well as the proposed measure. What is interesting to see is that the other jurisdictions, especially the tight oil ones, where most U.S. oil and gas investors have, at least pre-COVID-19, have put in their money in the oil and gas sector, they yield sometimes 8 to 9 times the value per barrel of the Alaska's current fiscal system, and obviously more than 20 times in some instances when compared to the ballot measure one. A look at the government take, you could say that from a government take perspective, under the current oil price environment, under the base case, not the current, but under the base case scenario, Alaska's current fiscal system appears to be competitive at that price scenario at 60. However, the ballot measure one drops it towards the bottom of the peer group. It is the highest rate except for Angola and Norway. To conclude this presentation, we're going to sort of focus first on the timing when this change or the proposed measure is occurring. It is introduced at a time when the oil industry faces twin crises, the COVID-19 crisis as well as the oil price crash. So while it is no doubt that in the low oil price environment of 25 to 35 or even $40 per barrel, the measure is going to have a devastating impact. It is also not sustainable under a $60 per barrel base price scenario. So even long-term, this measure is not sustainable and puts Alaska at the bottom of the peer group. From a net present value per barrel, currently, Alaska is one of the least competitive ones within the US and international peer groups. A combination of relatively high unit costs needed to bring Alaska North Slope oil to the market, as well as a highly progressive fiscal system, contribute to lower project profitability compared with the lower 48 and international jurisdictions. Obviously, ballot measure one is going to further deteriorate Alaska's competitive position, and this measure is likely to affect 84% of the current production in the state. From a total net present value perspective, projects in Alaska under ballot measure one are likely to lose anywhere between $450 to $700 million per project. And as well as from a government perspective, while Alaska's current fiscal system or current government take, not necessarily fiscal system, current government take is considered competitive, it becomes one of the least competitive ones in the US and internationally. From a fiscal stability, this measure is going to further add to the instability of the Alaskan fiscal system. It comes at a time when other jurisdictions are taking measures or have either proposed or taken some measures to lower the government take. Alaska's measure goes against that trend and further deteriorates Alaska's competitive position in the global oil and gas markets. With that, I conclude my presentation, and I would be open to receive questions from participants.
Great. All right. Well, thank you so much for that presentation. And we will go to audience questions. And let's start with this one, Irena. Can you, just to confirm your methodology for everyone, can you talk about what you've included in the term government take? Is it inclusive of royalty, severance, ad valorem, and corporate income tax?
Yes, it includes all fiscal measures applicable in Alaska. It includes royalties applicable in North Slope, federal income tax, state income tax, ad valorem taxes, even rentals imposed by the state. All components of the fiscal system are included. We have very detailed models that are in-house proprietary models where we update them frequently. It has all the components of the system.
All right. Perhaps a question that is on the audience's mind is that you're presented some scenarios on both low and high per barrel price scenarios. Do you have projections for oil prices in the coming 12 months, 24-month period?
For 2020, our average crude oil price, it wasn't part of this analysis, but we do internally have crude oil price projections. It is just under 40, and it is expected to go to towards 45 to 48, just under 50 for the 2021 calendar year. So, and this will depend on a number of factors. We have various projections, but this is kind of a sort of an optimistic case where we see COVID-19 crisis being sort of handled and OPEC plus sort of complying with the sort of the, at least the terms that they have set, or continue to interfere in the market. However, there are other scenarios that if we see a W recovery, there are scenarios where oil price is seen to be significantly lower, perhaps averaging at $30 per barrel. And a less likely one, a highly optimistic scenario, assuming everybody comes out of the crisis early. That doesn't appear to be the case. So our analysis is actually based on our base case scenario where we consider a low, generally a low commodity price for the up until 2022, and gradually picking up to the pre-COVID-19 levels.
All right, thank you for that. I'm afraid as an Alaskan, I can't resist this next question, but it requires a little bit of context for you, I think. We have a very popular bar here in Alaska whose motto is, "We cheat the other guy and pass the savings on to you." So in terms of other jurisdictions, how do you see them dealing with the populist case for increasing prices on the oil and gas industry?
Well, in terms of increasing, the jurisdictions don't necessarily have much of a control on crude oil markets. There was a discussion, for example, in Texas, and I believe in Oklahoma. I'm not sure to what extent in North Dakota, but it was somewhat put on the table to see if the state could intervene and place production quotas. That measure was not taken on board by the Texas Railroad Commission. So basically, whatever production cuts were implemented in the United States to affect the crude oil price, they were done by the industry because they could not support drilling. A lot of companies went bankrupt, so they had to shut down production, especially the smaller players. They do not have the bandwidth or the financial capacity to keep on going when prices go down, so they had to shut down. The larger, the majors or the super majors, they had more bandwidth. They didn't shut down immediately, but they had to take a conservative, to be conservative also in terms of new drilling. So that was done, but not in a regulated measure. Yes, tight oil was affected more because of the nature of these developments, and those were the at least in the lower 48 higher per unit cost. It's not as easy to shut down a conventional oil field development. Once you have started producing, you can, am I still connected?
Yes.
Once you've started producing, you cannot shut down the development of a conventional oil field. Whatever costs incurred previously are considered sunk cost, and the theory is that you will continue with development and production.
All right. We have some questions that actually speculate onto the motivation of the Alaska Fair Share Act, and some of them I think are probably not quite fair to you in terms of what those motivations might be. But let me try and parse a couple of them to aspects of your analysis. So is it possible for you to estimate reduction over time in both development, or I would characterize that as investment, and production as a result of the Fair Share Act being implemented?
Obviously, the existing developments are going to go, projects that are under development and have been sanctioned, they will go forward. However, future developments will, perhaps the companies will think twice. They will be delayed for sure. First of all, they will try to weather the current low oil price environment, and depending on when commodity prices reach a level where they can support development of these projects, they might. But also we have to consider that companies have global portfolios, and that's why we looked at the competitiveness globally. So while they may have these fields that they have discovered in Alaska, basically the brownfields, they don't necessarily have to move forward with new developments if the market conditions are not favorable, or if they are going to get better rates of return. For example, if you are Exxon and you have Guyana, we presented Guyana with a higher break-even price, but according to Exxon, they can get they can break even and make profit in Guyana at $35 per barrel. So when they look at Alaska, I'm not speaking for Exxon, but I'm talking generally in terms of what a prudent investor do. They would prioritize the jurisdictions where they get a higher return on their investment. So when it comes to portfolio optimization, Alaskan projects will end up at the bottom of the pile, so to speak.
All right. Okay, we have a question. We have seen significant increase in interest and investment in the North Slope under the current tax regime. Yet one of your scenarios, I'm having a little hard time reading this, but one of your scenarios suggests that investors would prefer to invest in other plays. I think that's in the net present value. It looks like 10 at 10 per barrel, but that doesn't sound right to me. But anyway, can you speak to what the motivations might be to invest?
Alaska has huge resources, so materiality obviously is important. So I'm not saying companies are going to ignore Alaska, but compared to other jurisdictions, it is likely going to sort of take a lower priority. That yes, some of the major companies still have, had plans. I cannot talk about their future plans because I'm not aware, and I'm not even entitled to make that prediction. But when you look at it, it is a matter of dollars and cents. And you, as an investor, are going, especially in a market where oil and gas investments in oil and gas are not considered sort of a high return investment anymore as they used to be. Companies, now there's the technology companies or other types of investments that the financial markets are willing to support. They're less willing to support investments in oil and gas. So it is only companies that have significant cash that can support or justify these investments. But when it comes to borrowing, and that's why you do not see or some of the smaller players left Alaska, they cannot justify borrowing money to invest in Alaska when there are projects that yield higher returns in the lower 48.
Great, thank you. Yeah, what I couldn't quite read, sorry, was that the net present value at the 10% discount rate. So clarification there. I think you answered that question. All right, well, again, to our audience, if you have any additional questions, we have a few more minutes and we do have a few other questions. Some of them, again, a little bit perhaps focused on the Fair Share Act itself and what the motivations of the proposers are for that particular measure. Let me see if I can characterize this. Are you seeing in other jurisdictions proposals to increase taxes in the oil and gas industry to impose these higher costs due to some great public costs, or more like a triple or quadruple bottom line analysis that would justify an increased tax rate?
Not actually, and we did an analysis for the U.S. government that was completed last year in 2019, and looked for BLM at lower 48 and Alaska, and it was an interesting comparison that what we found out, Alaska's reliance on oil and gas is much higher than any other jurisdiction. It used to constitute about 20% of GDP around 2013. It dropped to about 8% of GDP in 2019 when we were looking at it. But in other jurisdictions, such as Texas and the others, it had dropped to less than 5% of the GDP. They're not as reliant on oil and gas revenue as Alaska is, and therefore these states are not considering measures to increase the government take. When we looked at the cases of both Colorado and New Mexico, the reason for the increase in royalties there was more just to align with royalties levied by other states as opposed to increase revenue when it happened in 2016. Why do we say that? Because if they wanted to increase revenue, the royalty only applies to state leases, and the areas under state land are far more limited than areas under private jurisdiction or federal land in those jurisdictions. So if they really wanted to increase revenue, they could have increased sovereign taxes that affect private, state, and federal leases in the jurisdiction. So basically, to answer your question, we haven't seen any measures to increase government take in other jurisdictions.
Okay. We have a question that your analysis suggests that medium and small companies would leave or not enter Alaska, leaving only the major producers. Is that your conclusion, that the smaller independents that we've seen would leave Alaska?
No, what we didn't say would leave Alaska. We said we noticed they had already left Alaska. So there's a difference in the and when we're talking about this analysis, it only focuses on the North Slope onshore, and it's only basically majors there already. So it is, the market is kind of set with regards to the brownfields that we considered.
Yeah. Well, one last question. You know, obviously the industry is facing tremendous headwinds. Oil and gas are facing tremendous headwinds. Do you have any projections in terms of shifting demand away from oil to natural gas, LNG, or other alternative fuels that are factored or considered into your analysis?
Well, globally, I mean, companies are trying to take measures towards energy transition. They have the European companies more so than the US companies. The renewables and other sort of environmentally friendly sort of investment are taking a bigger a share of their portfolio than perhaps some of the companies in the US. It's a slow process. When we look at long-term commodity prices, there are a lot of factors that go into that. I'm not really an expert on crude oil markets. We have a team that deals with that, but definitely energy policies, transition to other types of fuels, macroeconomic crises such as even COVID and other things, all these factors go into our crude oil market forecast.
Right. All right. Well, we're coming up on 1 o'clock. And so I want to thank you, Irena, for being with us today and your presentation. We appreciate it very much. I do want to let our audience know that we will be having additional programs coming up on September 30th. We do have an event scheduled with what we're calling the big three: oil, fish, and visitors, and looking at those sectors in a COVID and post-COVID world, and what the economic impacts are, and what projections are for the future. So please consider joining us for that. I have provided a link in our in the chat feature, and we've also provided a link for a review of today's program. We'll also be emailing that out, but please take a moment to evaluate the program and give us any feedback on how we can improve in the future. We appreciate that feedback. So again, thank you to Irena and IHS Markit for the analysis and sharing it with us today. And with that, wish you all a good day, and please join us again for a future program. Thank you so much.
Thank you for giving us the opportunity to present this.
Great. Pleasure to have you.